Welcome! This video is the fifth and final in a series called Market Access for Digital Entrepreneurs, brought to you by Seda, the Small Enterprise Development Agency, with support from the European Union. In this series, we have assembled a range of entrepreneurs, industry experts and subject specialists to share their insights and experience from different angles about commercializing startup digital products and services. These videos are first and foremost for entrepreneurs, but we hope they will also be of interest to incubator and hub managers and business advisors. In this webinar, we will take a look at obtaining funding for your digital venture in South Africa. We will explore the steps to obtaining funding, the difference between angel investors and venture capitalists, and discuss the importance of having an effective business plan and the traction that investors want to see. Fund your next digital venture. Let's begin.
I want to say welcome to all of you, because collectively this is the space we want to fix things and get it right so that it's a vibrant economy that we can all participate in. So today we are going to talk about that tension point, about the investors that invest in Africa in the early stage and the startups that receive investment from investors. And these two pockets are very often misaligned because many investors enter Africa and they don't really understand what's going on the ground. Their programs do not cater for tech startups properly that has to operate in Africa. And then also the startups do not always know how to talk the investors' language, and they do not know what are expected, especially in this early stage of funding. That's the high risk phase.
Okay, so just a quick presentation in terms of CIFA's offerings. As you'll know, as CIFA, to contextualize why we're participating here, we are an implementing agency of the department ourselves and Seda. So in terms of the discussion this morning, as you know, that Seda has got a variety of incubators doing a number of things. So incubator has prepared businesses, those type of businesses, in terms of access to finance. Some of them need to be assisted through the offerings that we do have. I'm saying incubators because in terms of the discussion today, when it comes to tech businesses, it's easier to access finance if you have been through that kind of a channel. The reason I'm saying this again is, as a CIFA, we provide debt funding. There is a shortage of money for tech businesses at that critical phase before they go and generate revenue. So we don't have, as a CIFA, patient capital to do that. We provide debt funding. That is why the link between Seda and CIFA through the incubation process becomes critical. But the critical part then is to say, to identify the problem that you are solving with your solution. Because there are so many apps there are so many tech initiatives out there. But if you're just selling a product, it becomes a bit difficult. But you identify a problem that you're solving with your solution, that makes it easier. We do provide funding to start up businesses. So we can provide funding for asset finance. We can provide funding for bridging loans. If, for instance, you'd like to be having contracts when you are ready to go to market, we can provide funding in terms of that. We can provide funding for term loans. It could be for any other fixtures or fittings. So we are able to provide funding and also for working capital. So what it says is that the debt funding that we have can cover a number of assets or working capital that you need to start your business at that early phase. When you come to us for funding, the issue of predictable cash flows projected becomes very, very key, which is a challenge really for businesses at that phase. This gives you, and I won't go line by line in terms of this, but it gives you an indication to say when you pitch your business at CIFA, what are the things that will require? It's a digitized template which you can easily use. It's on our website. You go under CIFA website, under our application for finance, you go common application template. What it's doing is this, it's a template that we have developed together with Seda, together with IDC, NEF, and also the National Youth Development Agency. Is then to say, when you pitch your business, what are the things that you'd like to see in your pitching document? So that is the list or the categories. It makes it easy for you rather than come with a broad business plan, only to find that in the business plan that you provide to us, we can use, say, 40% of the information, and there will still be gaps in the business plan. So this is a focused approach, and it's saying what are the things that we would want to see in a funding pitch proposal, and it's digitized. To make it easier for you, it's digitized on our website. You can go in there, click it, ask very, very basic questions. As you respond to those questions, in the background, it's building a pitching document for you. When you approach lenders like ourselves, where we don't have equity, you will frustrate yourself and frustrate us if you are actually looking for an equity investor and you don't know that. So I think this slide is trying to say, if you ask yourself one thing, for instance, the issues around equity, patient or early investment, patient capital, there are no monthly repayments there, because it's an investor who say, here is an investment, go and do what you have to do. Once you start breaking even and generating turnover, that's how they're going to recoup their investment. But now what it means, therefore, you need to give up a portion of your business, because an equity investor will like some equity in the business, shareholding of some sort. Ourselves, debt funders, you retain full ownership of your business. We don't take equity businesses. But now what it means therefore, when you come to us and apply for funding, you need to be able to motivate positively so the turnover that you're projecting. So this becomes very key to understand which direction to go. If you are not so sure, you don't have those letters of intent, you don't have those offtakes, as it were, it might be worth a while to approach equity investors. And I'm sure maybe throughout this morning, afternoon, there will be equity investors who can unpack that path, as it were. So our contact details, that is that, our website, you can visit us on our website. You can dial our call center. We are reachable on an email as well, helpline@cifa.org.za, and a variety of social platforms. Twitter, you can follow us at the Real CIFA. We're also on Facebook, LinkedIn, and that's my email address there in case you need to drop me an email and you need something specific. I'll be able to respond to you. Anyone who is a South African citizen, your right order, is eligible to apply for CIFA funding. You have to be a South African citizen. The business must operate within the Republic of South Africa. It's very, very basic criteria. What you may want to do, remember I said we have got our template digitized. We also have an online application portal. So if you visit our website, go under apply for finance, there's a drop down that says apply here. It's a quiz question. The portal will ask you quiz question about your business. If you are eligible to apply for CIFA funding, it will give you an access to our form, which you can complete and submit at any of our regional offices.
Very brief presentation about me, but I've been investing in Africa for many years through various investment strategy. But the most relevant one for you guys today is angel investing. I'm a director at Dazzle Angels with Audrey Verhaag. Dazzle Angels, as you might know, was at the time one of the first angel club founded by women and only investing in women-led tech businesses, because it was quite critical for us to support female-led startups in South Africa. So I would like to go back to the point made by Janine. It's actually very important for us angel investors to have this ability to connect with incubators, accelerators, and other innovation hubs, because these entities are actually the entities providing us with deal flow. And as Janine has said, you guys should really take this opportunity, like this type of forums and startup competitions and all these kind of scenes, to actually reach out to us angel investors and to see to which extent we can work together or to which extent we can introduce you to the relevant people. So we can go to page 3. So I just wanted to quickly re-explain that today we'll focus on entities that are operating at the very early stage of the startup, when you are like at day 0, where you just have a PowerPoint presentation and a great idea and you would like to turn it into reality. We discuss about entities who are also helping startup at the pre-seed level and to some extent at the seed level. It's very important for you to understand what is the level of maturity of your startup so that you know what type of entities will be able to add value to your startup. So we start typically with incubators. Incubators, I mean, there are various definitions, but I'm trying to be as simple as possible. But incubators are typically the first sort of collaborative designated program that is put together to identify, select, and support potential startups. So those startups can be formalized, or it can be one individual with an idea going to an incubator and having the right setup to, put his idea into shape. So typically, an incubator will provide a startup with obviously workspace, connectivity, internet is key, and also visibility to potential funders. So as Janine said, it's very important for everyone in the ecosystem to try to be as connected as possible, to form partnerships and to create an enabling environment for startups. On a side note, I'm also on the investment committee of Launch Africa Ventures, which is an early stage fund investing in startups in sub-Saharan Africa. And obviously, as an angel investor and quite active in the scene, it's also a good investment vehicle for the startups that are evolving in my ecosystem that I can share. And Launch Africa Ventures is quite active in terms of providing funding to some extent at the pre-seed, but also at the seed level. When you go to an incubator, obviously, it's important for you to understand that you will have the opportunity to network, to receive mentoring, training on various skills, including, presenting and pitching, all these things that will be very important the day you start interacting with institutional investors. Depending on the quality of the incubators, you might have access to what we call shared support services, whereas the incubator can provide you with accounting services, marketing services, tax services for your startup. So obviously all those things are really value additive. Last point that is quite relevant for a few startups that are really specialized, obviously an incubator can definitely assist you with IP management, regulatory issues, or legal topics. I guess in terms of structure, incubators are great, and in many countries, including in Africa, they tend to be non-profit, but frankly, we see that more and more incubators are trying to become more sustainable and to be a bit more commercial, because obviously providing services to startups is quite expensive, and you want incubators to be able to be self-sustainable. So we see few incubators now requesting either a minor subscription fee or taking a minority stake in the startup. So all these options are potentially relevant. But as a startup, it's really your role to actually do your DD on the incubator you are considering, check the startups that have been incubated, how these startups are doing now. So I've just put at the bottom of this slide a few examples of incubators that are quite active. I think I have not put Accro Capital. Accro Capital is amazing. So definitely something you should check as well. Yes, I think this is it on incubators. I will take questions on that slide if relevant. So once you've gone through an incubator, Akro is actually here. And this is a point. A lot of incubators, like accelerators, are actually providing similar services and sometimes taking care of startups at similar level. But I guess to simplify the point, you, the startup, should keep in mind that typically an incubator will take care of you between day 0 and pre-seed, while an accelerator will take care of you between the pre-seed and the seed level. So again, an accelerator is much more focused on startups that are operating, that are quite advanced. Definitely, often they have functioning MVPs, they have pivoted a couple of times, and they found business model that is likely to work. And accelerators like to see some level of tractions for the startup, so not necessarily revenues, but at least pilot signs with like major corporates, or some signs that the startup will be sustainable. Also, you have to know that obviously, given that accelerators are taking care of startups at a level that is a bit more advanced than incubators, they tend to be quite selective. The application process for startups can be quite extensive and hectic. And typically, accelerators will start to work through cohorts. So every 6 months, an accelerator will take 20 to 30 startups, and then for 6 months, they support you, and then they move to the next cohort. A lot of accelerators are actually quite, generalist, but some of them are started to be specialized in certain sectors, such as Ocean Hub, for instance, who is looking at startups who are operating in the sea industry. A lot of accelerators are private, and they are looking to make profits, so definitely looking to have exposure to the startups that they are backing through equity. So innovation labs, that's a concept that is quite new, and I've tried to put several definitions that will help you understand better the concept. But it's basically, environments where typically corporates or NGOs or public organizations will put together, teams and environment where disruptive ideas can be fostered. So this is where you will see different type of structures. You can have innovation labs that are actually within a company. You have innovation labs that are outside companies. So for instance, I've put at the bottom of the slide the example of Alphabet, which has an innovation lab called X, which is kind of generating new ideas for Alphabet and Google in terms of new technologies and new sectors to venture into. Innovation labs are quite important because they really try to support innovation. They really use cross-functional expertise, so teams including people with various skills like science and finance and IT and any other sectors, to make sure that the ideas that are putting together are very, very innovative. When you put together in an innovation lab or a project, it's quite important to understand why you're doing that. And you have to understand, are we trying to put together an idea or a concept that is going to, increase the revenues of a company, change the dynamics of the sector? It's just market research. So it's quite important to define all of that. And very often innovation labs will collaborate with academics, either in their personal capacity or through an academic institution. I just wanted to reiterate that there are other, players adding value in the ecosystem of the startup at those early days, like between day 0, pre-seed and seed, with various strategies. And as Janine mentioned it from Acro Capital, you will have angel investors and club and networks, and some of them are actually operating even at the D0 level. So from this perspective, I invite all of you to have a look at ABAN. ABAN is one of the Pan-African organizations of business angels that is including a lot of members who are investment clubs. So for instance, Dazzle Angel is part of ABAN, and ABAN can give you access to many clubs, including in South Africa. So Josie Angels is part of ABAN, and there are a bunch of clubs all over the continent who are active there. So it could be a good source of information to find the clubs or the angel investors who will be able to assist you in your funding. I'm mentioning also corporate VC that is actually quite active, especially in South Africa, but also on the rest of the continent. For instance, Orange Ventures in Francophone Africa is very active and investing in many startups. But again, the ticket sizes can vary between like $100,000 up to $1 million. So you really have to check the maturity of your startup and whether you fit the criteria. But sometimes it can be a solution for some of you guys. And I'm just mentioning the Fat Labs, who from my perspective are also a big part of the innovation labs, to the extent that there are physical spaces where typically very innovative tools and equipment are put together. It's open to the public and it enables people to develop their skills, learn new skills, and create and prototype. And in South Africa, there are two of them that are quite well known. I don't know to which extent they are active or effective, but I've put their names there, including the Craft Design Institute. So these are things you can consider as a startup when you are in this phase where you are trying to put your MVP together, or you are trying to network and create your ecosystem. And I think that's it. So basically, if I try to summarize the message that I wanted to give you today, as a startup, you have to be aware of the level of maturity of your startup, and you have to know that the earlier you connect to your ecosystem, the better it will be. And the best connection you can have through entities like incubators, accelerators, innovation hubs, and other entities that are here to support you, not only financially, but in terms of helping you securing commercial partnerships, building your team, opening new markets, helping you refine your business model, your MVP. So it's important for you as a startup to connect to those ecosystems as early as possible. And as Janine said, we are here to help to the extent that our schedules are not too hectic.
The difference really between angel investing, aside from stage, is just that it's like, are you deploying your own capital or are you deploying other people's capital? Meaning angels deploy own capital, VCs deploy other people's capital, and some of their own as well. And based on the talks that have happened so far, I feel like it's probably helpful to talk at it from the perspective, at least from an international perspective, as to how would a VC look at these opportunities, particularly an early stage VC. We are exactly that. We have people working out of offices in San Diego. We have people in Johannesburg, people in Cape Town. Average check size is probably in the region of about $500,000 to about $2 million on the VC side. So $500,000 would be a relatively small check for us for an international opportunity. On the angel side, we can go down to about $100,000. But I think that many of the principles that we apply when we're thinking about these opportunities apply equally, whether you're looking at it as an angel or you're looking at it as a VC, because we're investing at the early stages. And so I thought that what I'm going to do is take you through how we look at a pitch deck. I always assume that people know what a pitch deck is and they know what a VC wants to receive when you're pitching them. But it's super important to understand that, we spend about maybe 5 minutes on the typical opportunity that arrives in our inbox. So it's really important that we get the right kind of information that addresses the most important questions that we will have about whether or not we are going to pursue this opportunity. And it's also important to understand that we look at it from the perspective of, we have a negative bias when we look at it. So we're not looking for reasons to invest, we're looking for reasons not to invest. And the reason why is because there is a lot of what is called information asymmetry at early stage investment stages, which means that there's a lot of stuff that we don't know, and frankly, even the entrepreneur doesn't know about the risks that are existing in that opportunity. And until they've executed upon their plan and have a couple of years of traction, we won't even know about those risks. And so we are really just going, what are the most important factors that we want to look at, and how does the technology entrepreneur or startup rank up against those factors? And then, how are we comfortable whether or not we want to proceed? So one thing is I won't go into too much detail. If you ever need any entrepreneur, if you need help with a pitch deck, if you need any help with getting your your pitch right or understanding how does a VC investor look at the opportunity, we have something called open VC office hours. Every single Friday, you can book 15 minutes with us. You can do it every single Friday for the whole year if you want to, and there is no strings attached to it. So you don't have to be like, well, if I use your time, do I have to take your money? No, you don't have to do anything. You can bring all of your questions in those 15-minute slots, and please do take advantage of that if you'd like to. But in terms of the pitch deck, again, because of us spending so little time on the average new opportunity we're looking at, think of it as a 30-second ad. So we only really want about 10 slides, which are addressing the most important factors that we're going to look at least in the first phase of the opportunity. So we don't proceed from this is a new opportunity to, okay, can I write the check in this phase? What we're trying to do is go, is there an initial interest, and do we want to look deeper into the opportunity? So think of it as an advert, don't think of it as a book. The book comes later on, you can give us all the detail later on. Initially, we want 10 slides that summarize the opportunity, that get us excited about it, and that give us the confidence that you know enough about the opportunity to give us, to know how to be able to execute on the opportunity. So the kinds of things that we will look at is, what is the problem? What is your solution? What is the product? Why now? Is this a solution that is appropriate to the market? How big is the opportunity? What is your business model? What does the competitive environment look like? Why is this the right team to execute on the opportunity? A little bit about existing and future financials, and ultimately, what is the deal? So from a problem perspective, I prefer to look at opportunities that are addressing pain points. There's another type of opportunity, which is a gain creator. Which I think is harder to finance, because it's one of those things where you're more likely from a user perspective to be able to step away from it. Whereas if you're really solving an important issue for somebody, then it's much less likely that they're going to do that. I also want to know, how does that compare to existing solutions? So when we're looking for opportunities, we're specifically looking for disruptive innovation opportunities. And it's really important that entrepreneurs also understand that we're not using that term in a loose way, the way you would sort of read about it in the dictionary. We're using it in a very specific way. And if you want to know what that very specific way is, please go and read all the good work that Clayton Christensen did on disruptive innovation. And really, the principle there is we're looking for opportunities that are addressing underserved segments that are able to start at the bottom end of the market, and as they become more and more compelling, they're able to move up market and ultimately capture what is an existing market that is very large but is served by current solutions, and where there's an opportunity to sort of change the basis of competition and ultimately capture more and more of that market. We also want to understand a little bit more about the solution, particularly what is it that makes this different? How is it going to be used? Why is it important to your customers? And make sure that it's easy to understand why this is compelling. From a product perspective, what we want to understand is, how far along are you with the development of the product? Is it that it's still an idea? Is it that you have what is called the minimum viable product, which is typically at the VC stage, when we would look at opportunity that is anything less than a minimum viable product? And what that is basically, do you have the ability or rather, can your users or your customers actually use the technology, or is it not yet ready for them to use it with a basic feature set to solve their most important problems? I also want to, as I said, know a little bit more about the technology that you're using, and we want to know about what that product roadmap looks like as well, but very high level, not in a lot of detail. On the timing side, it's important for us to time VC investments correctly, because what we're effectively wanting to do is to invest into something that is just approaching a disruptive market opportunity, but it's not yet mature. If it's too mature, we don't have the ability to do 10x returns. If it's too early, similarly, the market is not ready, is not going to adopt. It's going to be more capital intensive for us. And ultimately, we're going to have challenges in the first period with traction. So it's important for us to know, why now? Why not next year? Why not, last year or 5 years ago? And it's also important for us to understand, how have you validated the market opportunity? And so what that effectively means is, Have you generated revenue? Do you have users? So like, can you prove that somebody out there is willing to part with their money in order for you to solve their problem? And do you have any kind of early data to tell us that your solution, at least in an early stage, is solving for that? Market size is something that is by far the biggest problem that we have with entrepreneurs. I can't tell you how many pitch decks I receive where somebody will tell you there are 50 million people in South Africa, and if we capture 1% of them in the first year, then we have a viable business case. That's not how you assess the market size. So it's important as an entrepreneur that you get used to these ideas of a total available market, a SAM, which is a serviceable available market, and then a SOM, serviceable obtainable market. And in summary, what those things are really just is like, how big is the total market opportunity for the thing that you're trying to do? Then it becomes, which part of that do I want to go and address? And then which segment am I going to go after first, which is the obtainable market? To give you some indication of market sizes that we think are compelling for disruptive innovation. So a TAM should be at least $1 billion. A SAM should be at least $100 million. And when you apply those numbers to the South African market alone, you often find that technology solutions struggle to get to those TAM and SAM sizes unless they're addressing the bulk of the market. So just be very careful about that. It's really hard to get to those numbers if you're trying to address the sort of the top end of the market in South Africa. From a business model perspective, we want to understand, how are you going to market? In other words, is this something that you're going to be selling through channel partners? Is you selling this online? Is there some other way that it needs to get to market? And then ultimately, we want to know, how do you make money? Our preference is for recurring revenue business models. So, and we never invest into service-based business models because they don't have non-linear cost versus revenue relationships. So, service is okay if it's an enabler, but it can't be the primary revenue. From a competitive perspective, this is another really important thing that entrepreneurs get wrong when they're pitching us, is what they often do is they do a matrix and they say, oh, here are competitors in this quadrant and these are competitors in that quadrant, but they'll pick the basis of competition that is most, that presents them in the most favorable light, which is not really the issues that the customer cares about. So when you do the competitive analysis and you show us a matrix of how do you compare against the competitors, please make absolutely sure that it is the thing that the customer cares about that you're comparing against, not the thing that you are able to look best at. So good indication of that is when an entrepreneur is trying their luck, is when all the other competitors are in all the other quadrants and you're alone in the one quadrant. That's not realistic. And it's a pretty good indication for us that you don't really understand the competitive environment. From a team perspective, we're looking for people that give us the comfort that they understand the opportunity, that they have experience in this industry or with this technology, and that we believe that they'll be able to execute on the opportunity. I don't really care about advisors most of the time, unless it's a very deep tech startup, in which case we're looking for people with PhDs. But for the most part, it's not impossible for an entrepreneur to be successful in a space that they have no experience in or where they don't have any formal qualifications. It's just highly unlikely. And we're in the business of banking on opportunities that have a higher probability of success. And all of these kinds of things, particularly around whether or not we think the founders are capable of executing, add to our likelihood of success. So you'll find that if you're going after an opportunity where you don't have experience and you don't have the credentials, you're going to really struggle to get the funding. On the financial side, we look at the progress that you've made so far and the progress that you're expecting to make into the near future and the amount of capital that you're going to need in order to do that. And also, who are your most important investors up until this point in time. We, as a ballpark, we would typically invest at, once you've done something called annual run rate of more than $500,000. This is, again, VC style. And we're looking for 2 to 3 times top line revenue growth per annum over the life of the investment. And that's really aggressive growth. But what I often see is pitches where entrepreneurs are saying, oh, we'll grow 4 or 5 times year on year. Now, it's not impossible to do that. It's just highly unlikely. And so this also gives us an indication of whether or not we believe that the financial model bears any resemblance to reality. It is good to know, though, that we will, in any event, recheck all the assumptions in the financial model. So don't worry too much about getting it wrong. Do worry about getting it very, very wrong, which will tell us that you're not in touch with reality on the opportunity. And then I guess finally is just, what is the deal? So how much capital do you want? What are you going to do with it? And how do we get in touch with you? I think this is an important thing because, and I would even go a step further, and I'm not averse to entrepreneurs telling us up front what do they think the valuation is going to be. When you value the business, when you do the financials, please don't use rands if you're going to appeal to international investors. International investors don't care about rand returns. They care about euro returns. They care about USD returns. And sometimes they don't even know what the exchange rate is. And they don't know how volatile the currency is. And it just, it puts you at a disadvantage from a valuation perspective. I can't tell you how many Nigerian, Kenyan, Ghanaian, Egyptian, Tunisian, Senegalese startups there are that raise at higher valuations than South African startups just because they understand that nobody cares about the local currency. They care about the global trade currency and what my return is going to be on that basis. So don't put yourself at a disadvantage. Do your plan in USDs or euros and raise in those values as well. Another thing that's super important is when you're raising for an international VC, be very mindful of who you've taken capital from before and how that's going to restrict your ability to take from international investors moving forward. And why that's an issue is that international investors don't invest or hardly ever invest directly into South African jurisdiction entities. And that's not because it's a method of extraction of value. It's because there needs to be comfort that or rather they want to transact in a jurisdiction where they understand what the investor protections are, and they have comfort that the IP sits, for example, in a location where it is well protected from an investment perspective. So when you're raising your initial capital, it's okay for you to raise into a South African entity, but when you start to do maybe a seed or an A and you're raising a couple of $1 million into your entity, be very mindful that it's going to be exceptionally hard for you to do that into a South African entity. Not impossible, just very hard. So for example, all of the deals that we've done in the last 2 years have been done in offshore structures. There is none where we have invested directly into a South African or any African entity. It's always via an offshore structure, usually in the US, sometimes Mauritius, sometimes Hong Kong, Singapore, or in the EU. And that's, if you have any other questions, please do reach out. We're super helpful. We'd love to help entrepreneurs because we've gone through this journey ourselves. And you're welcome to get in touch with us as well at VC office hours every Friday. Go to our website and you'll be able to sign up there.
That was very informative and I think very straightforward in terms of what you require, but the depth of it comes with exercise and actually exposure. A quality entrepreneur builds a global business. And we just don't go there. I find a lot of the programs are just superficial, patching entrepreneurship, and I doubt actually that it can ever be delivered if an entrepreneur hasn't done it themselves. I want your view on that because you've just made a very powerful presentation and told them really what an investor looks for, and they don't always get that.
Yeah, I think it goes back to sort of addressable market size. And I think that if you can create a compelling case, so remember our investment horizon is 7 to 10 years. So what we're expecting for you to do is to double your revenue every year for 7 years. And if you do those calculations, you quickly get to really big numbers. Now, not everybody gets to those numbers. The point is that there's got to be the potential to get to those numbers. And so when an entrepreneur is looking for VC investment in particular, think of it as like you have a rocket ship that you've created and you don't have jet fuel. Like, we'll give you the jet fuel, but you have to have the rocket. And we have to have comfort that this rocket is going to be able to launch if we give you the jet fuel. So if you're trying to create a lifestyle business, or you want to create an opportunity that is going to give you maybe 3 to 4 times increase in value, and that's a nice business, but that's not a VC, a business that is conducive to VC funding. And the reason why VC investments have to create the returns that they have to create, so typically we're looking for 10 times what we put in, is because the failure rate is very high. And we're okay with the failure rate being very high, but it means that the winners have to do exceptionally well. And so think of it always in terms of like, how big is the addressable market size? Do I have to do it in South Africa? I think that South Africa has many disadvantages that from a regulatory perspective that don't exist in many other African markets. The most obvious ones are there are restrictions around IP transfer, there are restrictions around loop structures, and they make it really hard for international investors to invest into South African startups. So don't always think of it as I must solve a South African problem. You know, Israel is the best example in the world. Israeli startups and entrepreneurs don't solve Israeli problems. They solve global problems because the home market is too small to even bother.
There are 2 things I wanted to talk about. The one is the business plan. Now, the business plan is a critical element in this whole equation. And very often, certainly if you go to CIFA or to any provincial or state development finance institution, and some of the commercial funders as well, they'll ask for your business plan. And the business plan has got a reputation for being this magic wand that can unlock all kinds of good things, including funding. And I think we need to just reflect a little bit on the role of the business plan. The business plan is not a funding request. A lot of people think that when you attach your business plan to a funding application, that it's kind of, the plan itself is a sort of a funding request. A business plan is not a funding request. It's a working document, and some of the best business plans that I've seen are 2 pages long. And those of you who have used the business canvas and other similar tools will know that it's possible to capture a business plan that encapsulates your strategy, your business focus, your growth path, your key performance indicators, your risk management, your market analysis. It can be done in 1 page. And a business plan also needs to be owned by the entrepreneur. The second thing I want to talk about is this word traction. A number of the speakers have spoken about investors and funders wanting to see traction. And I think it's worth just unpacking exactly what that means. To my mind, there are a number of elements which indicate that you're getting traction. And for the benefit of our audience, let's just look at some of those. Firstly, traction implies that you are growing interest, that there's interest in your business, in your product or your service. People are starting to get interested. Customers and others. There's no substitute for customers. A key element of getting traction is customer acquisition, and preferably recurring customers. Recurring customers are extremely valuable. And it's not just the number of customers, it's the quality of customers. If your customer indicator is moving, you're getting traction. Validation, there are different forms of validation. Positive feedback on social media, for example, that's validation of your business. That is also part of traction. Traction is really all about perception, market visibility, customers, and most importantly, revenue. If those things are moving and you can quantify them and show them in numbers, you are getting traction, and that is what a funder is really looking for, because at the end of the day, you have to sell something to somebody. You don't have a business until people are paying you money for a product or service.
So I think there are two big barriers to digital finance, and specifically I'm going to speak about early stage entrepreneurs. I think the first barrier is the perception that raising funding is easy or easier than getting customers, and that you just need a pitch deck and someone will write you a check. So I think many entrepreneurs don't really understand how much work has to go into raising funding, and that it is a fairly lengthy process, and that you have to actually have all of your ducks in a row in terms of things like compliance documents. If you're going to successfully go through a due diligence process, you need to have a lot of information, and it does take a lot of time and preparation. And you need to understand and know your business intimately if you want to expect someone else to invest into the business. And that means being able to understand the key drivers of your financial model, understand exactly who your customers are, how you differentiated. Any entrepreneur on this call, I would strongly recommend you go and watch Lou's presentation about 10 times, because there are such gems in that presentation. And then the second is not actually knowing where to go for funding and not necessarily having the network available. Your network is absolutely critical, and building your network before you need it is really important.
I think all of us would agree that over the last few years, there have been really groundbreaking innovations that have come to the market. Even though we've had a very subdued macroeconomic environment. So the pace and the nature of what's come to the fore has really been phenomenal. But I think for me, and just from experience at our hub, there are fundamentally 5 areas we believe are barriers to entry. One, access to funds. Unfortunately, many of our incubatees, if you like, do not have a credit risk history. They are very engrossed in technology. That's why the commercialization aspect of their incubation is critical, because that essentially gives them insight as to what it is they need to look for. I think, to Alex's point, access to a business network is fundamental. If you could have a product, and the unfortunate thing is everyone wants to be an Elon Musk and have these huge plans. Nothing wrong with that. But I think it's really about understanding the processes that one needs to really get to that point. I think also for me, it's about the difficulty of balancing growth and quality of what you are producing or wanting to take to market. And then I think lastly, it's historical, and it's a mindset that needs to change, is that of an entrepreneurial culture. So I think it's mindset, it's business network, it's not understanding finance in its entirety and what critical components are required to really commercialize your product. So I think for where we find ourselves, Nelson Mandela Bay, we have about, across our 2 incubators, about 30 incubatees. All focusing on different aspects of technology. But what has come to the fore over the last couple of months is they've realized that, a payment platform everyone is developing. You really need to, as Alex says earlier, or one of the speakers spoke earlier, you really need to understand what it is you want to take to market. What is your differentiator? How do you, as the gentleman from Newton Parted spoke, how do you differentiate yourself from others? And all of those aspects influence the raising of capital.
I think what we are all doing actively is working on creating the ecosystems. So I think specifically what we wanted to do with Dazzle Angels, and Alex can kind of pitch in here if I miss things, but we wanted to create a model that could be easily replicated by groups of other women, or whoever it is that wants power, because the more angels we have that look different, that are different, that kind of sit on the investment side, the more people will get invested who look different and are different and who aren't fitting the mold of the traditional kind of credit checking VC world that doesn't need to exist in South Africa. So I think to get more people on the angel side, on the investor side, is just as important to get more people invested in.